All right, let's get right into it. Today, we're going to break down a company that is just an absolute giant, but one that kind of operates just out of sight. We're looking at this from an investor's perspective, analyzing the food services titan, Sysco. That's ticker symbol SYY. Think about the last time you ate out: a restaurant, a little cafe, even a hospital cafeteria. There's a really, really good chance the ingredients for that meal showed up on a Sysco truck. Their reach is just staggering, which makes them this crucial but often invisible part of our everyday lives. And just to put that reach into perspective, get a load of this number. This is their projected annual sales for fiscal 2025, over $81 billion. I mean, we're not just talking about a big company here. This is a colossal force in the global food supply chain. So, before we can even really start to analyze the stock, we've got to wrap our heads around the sheer scale of the business. Because for Sysco, its size, well, that's the foundation of the entire investment story. You see, Sysco is playing in a massive, and I mean massive, $1.1 trillion global market. They're the number one player, delivering pretty much everything you can imagine, from fresh vegetables to kitchen gear to about 730,000 different customer locations, from their 339 distribution centers. It's a huge operation. Okay, now this is where it gets really interesting. Even though Sysco is the undisputed leader with 17% of the US market, look at this. The top three players combined only control about 35%. That means the other 65% is made up of thousands of smaller regional players. You gotta remember this, because this fragmentation is probably the single most important thing going on in the industry, and it's totally central to Sysco's whole game plan. And that market leadership, it's no accident. It's protected by something investors love to talk about: a competitive moat. So let's break down exactly how this giant defends its profits from that huge sea of smaller competitors. A competitive moat is really just a simple idea. It's a structural advantage that makes it incredibly hard for anybody else to come in and compete effectively. And for Sysco, this moat is seriously wide and deep. So here's how they build that moat. It's really a three-part thing. First, their scale is just unmatched, which creates logistical efficiencies that nobody else can even touch. Second, all that scale gives them incredible purchasing power with their suppliers, so they get better prices on everything. And third, and this is key, they offer all these extra services, like helping a restaurant design a menu or manage inventory with tech. Those services get so tangled up in a customer's day-to-day that switching to another supplier becomes a huge, expensive pain. So, with all that in mind, how does this build into an optimistic case for an investor? Well, management has this really clear plan they call the recipe for growth, and it lays out some pretty compelling reasons why the stock could be a great investment. The bull case really stands on four main pillars. First, remember that fragmented market? They can just keep gobbling up smaller players and gain market share. Second, their international business is an absolute powerhouse. Profits have literally doubled in just 2 years. Third, that recipe for growth plan is actually working and making them more efficient. And finally, they are laser-focused on returning cash to shareholders through solid dividends and share buybacks. And this quote just sums it all up perfectly. The whole industry is consolidating, and as the biggest, baddest, most efficient player on the block, Sysco is in the perfect spot to capture more and more of that 65% of the market that's still up for grabs. Now, for shareholders, this is the number that really, really matters. Management has put a target out there. They're aiming to deliver a 9 to 11% total shareholder return each year. That's a mix of their earnings growth plus that nice dividend they pay out. It's a clear, straightforward goal for investors to keep an eye on. But, of course, no investment is a sure thing. We've got to look at the other side of the coin, right? There are some pretty significant headwinds out there that could definitely challenge that rosy picture for Sysco. The bear case also has four main parts. First, and this is a big one, if the economy gets weak and people stop eating out as much, Sysco feels that pain directly. Second, their core US volume, the actual number of boxes they're selling, has been kind of sluggish lately. Third, competition is always intense, and that can put a squeeze on profits. And finally, the company does have a good chunk of debt on its balance sheet. And that economic sensitivity, it's not just some theory. Look at this. Recent data showed a 3.1% drop in U.S. restaurant traffic in just 1 quarter. This shows you exactly how it works. When you and I decide to tighten our belts and eat at home, it directly hits Sysco's main customers. This slide just captures the whole story perfectly right now. It's this real tug of war. On one side, you've got the international business posting this incredible 20% income growth. But on the other, the huge US segment saw its volumes actually shrink a little bit. So the big question for an investor is, can that international engine keep pulling the train while the US market is slowing down? Okay, so what do we have? A dominant company, a strong international business, but it's facing some real headwinds here at home. And that brings us to the ultimate question for any investor, which is, what's the stock actually worth? Is it possible this market leader is being mispriced? At the end of the day, it all boils down to this one simple question. Is the stock priced attractively once you weigh all the good stuff against all the bad stuff we've just talked about? And folks, this is where the story gets really compelling from an investment standpoint. When you look at the key valuation metrics, Sysco just looks, well, kind of cheap. Its price-to-earnings ratio is sitting at 21. Its main competitors, way more expensive at 32 and 47. It's the same story with EV to EBITDA. But here's the kicker. Not only is Sysco cheaper, it's actually more profitable, with a much better return on invested capital. Oh, and it's the only one of the big three that pays you a healthy dividend. So the market leader is somehow the cheapest of the bunch. So the takeaway here is pretty clear. The valuation suggests that the market is really focused on that sluggish US performance, and it might be overlooking the company's superior profitability, its international growth engine, and its commitment to shareholders. For an investor who likes to find value, that disconnect is exactly what a potential opportunity looks like. So if Sysco is now on your radar, what should you be watching? Here's your checklist. First, can they get that US case volume to start growing again? That's number one. Second, are their profit margins holding up against inflation and competition? Third, can that international segment keep up its incredible momentum? And finally, are they still pumping out strong free cash flow to pay for that dividend and those buybacks? The answers to these questions will probably tell you whether or not Sysco is truly a mispriced titan.